Hi everyone, I'm Sidney McKinnon, MD and CIO of Cadiz Asset Management, and welcome once again to another installment of All Things Fixed Income. Today I thought I'd speak about a phenomenon within the financial markets, particularly fixed income as well, called the interest rate cycle. Now, we've all heard of the interest rate cycle, but what is the interest rate cycle and what does it actually mean for you as a fixed income investor? Essentially, the interest rate cycle is when interest rates move down or decline, or they move up or they rise. So what causes this? Why do rates move up and down? And effectively, it's related and closely tied to the health of your economy. So a country's economy would either be growing or it would be contracting or getting smaller. When a country's economy grows, it grows at a particular rate. And effectively, you don't want the economy to grow too quickly, because then it affects things like inflation and the price of goods and services become very, very expensive too quickly. And conversely, you don't want an economy to slow down too quickly as well, because then it has the risk of actually stalling the economy, and you will end up with things like unemployment, and growth slows down to a point where you cannot do new projects, and the expansion then is at a point where it is not lucrative or stable enough. Essentially, you want your economy to grow at a stable pace, or you want stability in your economy, so that the prices of services and goods are stable as well, and that everybody that enjoys the economy through employment or work, whatever the case may be, can actually function at a most efficient pace. Now, how is all of this controlled or affected? Now, in every economy or every country, so to speak, we have what is known as a central bank, and this central bank's job is to manage the rate of activity within an economy. Not only the growth rates, but also manage and try and control to an extent how quickly an economy is growing or how quickly it is declining. And they do this by using what is known as monetary tools. And one of the biggest monetary tools they have in their box of tools, so to speak, is the ability to set interest rates. And so often we hear, and they get together twice a month in South Africa, every second month, my apologies, and they set what is known as the repurchase rate. And we can always talk about the definition of the repurchase rate. But effectively, that rate, if they find that the economy is growing too quickly, that things are happening too quickly, and inflation is on the rise too quickly, they will set that rate and hike rates from where they are in order to cool the economy down. And conversely, if the economy is declining or inflation is declining too quickly, they will also then cut rates or make rates smaller or less, so that you can stimulate growth within an economy. Now, the objective of the Monetary Policy Committee or the central bank within a country is to ensure that the economy grows at the most efficient rate possible. In other words, you want stability within an economy. That's the best way to actually grow your economy, not only internally, but also being part of the global stage. What are the factors that influence this interest rate cycle and the way in which the central bank applies their monetary policy? I think a big one at the moment is inflation, because inflation is the rise of the price of services and goods within the economy. And if that rises too quickly, you could potentially land up with a situation where goods and services become too expensive, and the economy then starts being hampered by the fact that those who participate in the economy cannot afford the goods and services that are being rendered or being made available to them. And I'll speak about inflation a little bit more, because I think it's very topical right now where we are. And then, of course, there's other events that happen because a country doesn't have an economy or exist on its own. It exists within a global community. And if you have global risk events happening, like we saw now, we've had an oil supply shock, and I'll speak about that in a second as well. It also affects potentially the rate of inflation locally. But just to come back to the interest rate cycle, so you can see interest rates will go up if an economy is perhaps overheating and the central bank thinks it needs to hike rates to cool things down a little bit, and conversely if they will cut rates if they feel they need to stimulate the economy. And thereby you have the cycle of interest rates either going up, going down, and also, may I say, they may be stable for a prolonged period, because that's the point at which the economy is operating at the most efficient level. Coming back to fixed income investing, how does this affect your fixed income investing? Because you can be invested in fixed income products. For example, you can be invested in a deposit at the bank, and if the rates are going down, you're going to be receiving less interest. Not so great, is it? But conversely, if you are invested in, for example, bonds, and the rates go down, you stand to make quite a reasonable or potentially even sizable capital gain in your investment. So, whether rates are going up or down, being invested in the fixed income markets allows you still to be able to realize a gain on your investment. And there's various ways that you can achieve this. Having said that, what is happening right now? Where are we now in this interest rate cycle? And we've come to a point where interest rates have declined quite significantly since the COVID years, and there's been quite a bit of stimulus needed within the economy. That has happened, but suddenly, not too long ago, we had a global event where we had an oil supply shock as a result of the tensions in the Middle East. So the oil price shock has delivered potential for inflation to rise. We haven't quite seen it yet because there's a lag factor, but remember now, with supply being less or being curtailed, it potentially means the price of oil and related products that get developed as a result from oil becomes more expensive. And to get that supply to where it needs to be then becomes more expensive. And it affects other industries as well, like your transport industry. It affects also everything that's related to energy products as well, or energy prices get affected as well. And we're probably going to see this going forward. Now, what does that mean? It means if there is inflationary pressures in the system, central banks around the world have to be very, very vigilant now in terms of applying, as I said earlier on, their monetary policy. Because each country wants the economy to perform at the optimal level. And central bankers then have to be very vigilant in the way in which they apply monetary policy. So that's where we're sitting at the moment. Not quite certain where the rates are going to be cut or going to be hiked. Most certainly, I don't think there will be any rate cut soon, but the central bankers have promised that they will be vigilant in the way in which they apply their monetary policy depending on how the tensions in the Middle East play out. To pull this all together, the interest rate cycle effectively is a reflection or an indication of the health of your economy, and it is managed and controlled by your central bankers who apply monetary policy. It affects the value of your investments, particularly fixed income investments, whether they are going up or down, and is influenced by economic fundamentals such as inflation, potentially the currency volatility as well, or global events such as we are seeing playing out at the moment. I hope this little talk has actually shed some light on the interest rate cycle and what it means to you as a fixed income investor. That's it from me for now. I'm Sidney McKinnon from Cadiz Asset Management. Thank you.